I mentioned this earlier as well, was just the emotional attachment. I think it's easy to sort of fall in love with a property, even if you don't see it in person, or if you do see it in person as well, but you can fall in love with a property and you get your heart set on it, that you want that one. And then you can even go down this slippery slope of it's almost like a competition, and if other people are bidding on it and you want to bid on it and you want to win it and you don't want to lose that, so that emotional attachment can be risky because it can lead you to paying too much.
You're listening to The Growth Booth, the show focused on achieving lifestyle freedom through online businesses. Whether you're looking for step-by-step strategies to start building an online business, simple game plans to grow your business, or proven lifestyle freedom frameworks, you are in the right place. Stay tuned and be sure to join the thousands of listeners already in growth mode.
Before we dive into this episode here today, I think it's important that you know from the get-go that I'm not qualified to give you financial advice, and everything that I'm sharing on this episode, just like every episode of The Growth Booth, is based on my own experience and my own story, and I always recommend that you should seek your own guidance and counsel before making any kind of investment or business decision. So with that said, let's dive into today's episode. Aidan Booth here, welcome to episode number 22 of The Growth Booth, and this is the second in a trilogy of episodes that we're doing where we're focused on investments and wealth building in general. And today we're going to be talking specifically about property. Now, an area that I've invested a lot of time and money over the past few years has been in the Manhattan property market, and we'll talk more about that on this call. It's not how I got started. My first property was actually in Buenos Aires, and I've got some interesting stories that I can share with you about that. We've got a portfolio of different types of properties in New Zealand, and we diversified to the Manhattan marketplace for a bunch of reasons that you're going to find out as we dive in here a little bit more in this episode. So my special guest is Weimin Tan, and he's been someone that has been absolutely instrumental in helping me and my wife build up our property portfolio in Manhattan. We've got a whole bunch of properties up there now, and many of them we've been able to purchase without even going to New York, just because of the relationship that we've built and the expertise that we're able to tap into thanks to Weimin Tan, who you can find out more about by searching on Google Weimin Tan. He's a New York real estate agent, or by going to castle-avenue.com, and that's where you can find out about investing in the Manhattan marketplace. But before we get into all of that, I want to give you a little bit of a background. Now, our journey into real estate in Manhattan started by doing a Google search. I did a Google search because I didn't know anything about property in Manhattan, and this guy that we're talking to here today, his name came up at the very top of the list. So I sent him an email, and I didn't think he would reply, and then I think like 5 minutes later we were talking on the phone, and that's how our journey started. Must have been 6 or 7 years ago now. So Weimin, thank you so much for taking some time out of your busy schedule there to join us here today.
Thank you for having me, Aidan.
You know, one of the first things that I did before knowing a single thing about the New York property market was I hired a guy in Serbia, and he built a little program for me that scraped all of the different listings, I think on this website called Street Easy, and ran different calculations and gave me, and there were like thousands and thousands of listings, and ran calculations and gave me different listings and told me what my return on investment would be. And so I sent that spreadsheet to Weimin, and that was kind of how we started off our journey. Do you remember that, Weimin?
Yeah, I definitely remember that.
Probably a little bit unusual, but anyway, as it turned out, you can't just choose a property based on the numbers. So I sent this spreadsheet to Weimin, and I was saying, look, you know, here's one that's got 12% return on investment annually. Turns out maybe it wasn't in the right kind of location for, you know, easy renting and so on and so forth. So I learnt a lot after doing that. You know, Weimin has been down here to Buenos Aires. We've, hung out together. I see him a couple of times a year. And we're really good friends now. In fact, Weimin is one of the guys that I go to whenever I need to find a new book to read, because we like reading a lot of the same books. One thing that I think I'll never ever match Weimin on, though, is his fitness exploits, because he can do 352 burpees in 23 minutes, which I think is just insane. I'll do 20 of them and I'll be panting on the ground. And also a black belt in Taekwondo, which I didn't actually realize that, Weimin, but definitely someone who is dedicated to fitness as well. So that's a little bit of a background for folks. Today's show is brought to you by the Blueprint Academy, a coaching service that I've been providing for about 8 years now. If you're interested in getting one-on-one coaching from me and my team of experts, as well as being able to leverage the resources and infrastructure that I've got in my business, then head over to thegrowthbooth.com/academy to get all the details. I'm passionate about helping people build businesses online, and this is where I can help you. So again, head over to that link, thegrowthbooth.com/academy, and find out how we can help you at the Blueprint Academy today. Now, I do want to get into the good stuff here, and I think the first question that I want to ask is, why should someone consider investing in real estate? Why should that make up part of someone's portfolio? What's your take on that?
I think the key difference between investing in real estate versus stocks is that real estate is tangible. And what that means is that it's a lot more difficult to invest in real estate as opposed to investing in stocks. With stocks, you can just go online and someone would tell you, hey, I heard this company is doing this, and all you do is just click on the mouse. It's easy. So it's easy to get in, it's easy to get out, and therefore there's a lot more volatility when you're investing in stocks. With real estate, you have to invest time, you have to go and see the property, and there's a lot more involved. As a result, there's less volatility when you're investing in real estate versus when you're investing in stocks. So from that perspective, it may be more boring, but I'm a real estate guy because I grew up in a stock family, and I've seen the volatility. I've seen being in front of the computer every day, looking at the greens where it's going up and the reds where it's going down and so forth. So I decided that real estate is what I like to focus on. The other thing is that with real estate, you can use other people's money, as in you can use a bank's money. You buy a property with stocks, typically, unless you are doing margin. With stocks, typically you have to put in the full amount of the price, versus in real estate you usually would put in 25-30% and you borrow the rest. So that's called leverage. But when it appreciates, it's actually the entire property that appreciates. So your return on equity, meaning your return as a percentage of what you put in, is magnified.
I think leverage is huge. I mean, that's definitely one of the major upsides to investing in real estate. Is, like you say, you could buy something that costs $500,000 and you only need $100,000 of your own money, so you can get huge leverage there, and it's especially attractive in times when there are low interest rates. I think it's also a bit of a hedge against inflation. So in inflationary environments, real estate tends to hold its value. I like it as a portfolio diversification method. So, as I've explained to people who listen to the podcast in the last episode, I sort of divide up my investment capital between property and stocks. So I think portfolio diversification is really important. And you can actually build up that equity as well when you've got someone living in the place and they're paying off the mortgage for you, essentially, by paying rent. And then, of course, you've got cash flow as well, depending on the type of property that you're buying. So I absolutely love it. But talking specifically about Manhattan, because that's where you spend most of your time in real estate, and I know you've got real estate in other parts of the United States as well, but what is it that you like about the Manhattan real estate market?
With Manhattan, I think it's a few things. And I have properties in North Carolina, which I got before getting into Manhattan, and I have properties in Syracuse. With Manhattan, number one, it's a landlocked island. And there's very limited inventory. Landlocked island meaning that the supply is finite. Yes, there are new developments coming up, but as a percentage of the total inventory, it's actually extremely, extremely small. in terms of the inventory in Manhattan, 70% are rental or mixed-use buildings, which means that you cannot buy an individual apartment. You have to buy the entire building.
Wow.
That's 70%.
That's amazing. That's high.
Yeah.
Jeez.
Yeah, they can be big buildings owned by REITs, or they can be small buildings like 4 or 5 stories where there's a storefront down below and there's walk-up apartments on top. But that's 70%. And then 20% are co-ops. And co-ops are where you buy to live in, and there are restrictions. And then only 10% are condos. So 10% is the amount of condos on the island of Manhattan relative to if you go to any other US city, for example. There's so much land. So there's the city core, and the developers are always building further and further out from the city core, and therefore your supply is not limited.
Yeah.
Right? So number one, supply is limited in Manhattan. Number two, I think we are dealing with a higher credit quality tenant, which means that they have higher credit scores, and therefore it's safer.
It was quite interesting during. Sorry to jump in there. It was quite interesting during the pandemic. People often say, "Oh, how have you done with the real estate and stuff?" And we never really took a backward step. I mean, our Manhattan apartments were all rented all the time. We didn't have to do price breaks in the rent. And I know that in Manhattan, it's true that there are different segments of the market, just like anywhere. You've got luxury, you've got a lower grade as well. Most of the property that we've focused on there has been at the higher end. I'm not sure what the other different parts of the market, how they would have fared during the pandemic, but certainly in the strategy that you and I have been putting together, we didn't have any issues, really. Touch wood, I think we were lucky. But I think some of that has to do with this sort of supply and demand that you're talking about there.
We got a great deal during the lockdown. The lockdown happened between March to June of 2020, and we negotiated a great deal. The risk at that time was that we didn't know how long the downturn was going to last. And you took the risk, and we just increased the rents by, I think, about 25 or 30%.
Yeah. Yeah, to give people who are listening a ballpark idea, for a 1-bedroom apartment, which Weimin has been referring to as condos. That was actually a new term to me when I started investing in New York, because prior to that I'd always just called them apartments, so I didn't really know the difference. But if you're hearing us talking about condos, they are essentially just apartments. And a 1-bedroom apartment could rent, depending on the neighborhood and all that, it could be renting for $6,000-$7,000 a month. So that's a ballpark figure for that anyway.
Yeah, during the lockdown, we got the apartment, which was in the West Village. It had great views. Having great views is a luxury in Manhattan, because you want to be in an area where there's a lot of low-rise buildings, because when there are low-rise buildings, you get a lot more sky. Yeah. Versus when you're in Midtown, you are surrounded by all the very tall buildings. What that means is that it blocks the light and you get a lot less sky. You look out, you're looking at another building that's right in front of you. So the apartment we got was great.
I think with real estate, you really can make a lot of the money when you buy versus when you sell, if you ever sell. And one of the things that I've always liked about working with you is it means that there's one person at least who is not emotionally attached to the deal. So we would be negotiating back and forth, and Weimin would say, "Oh, no, you should offer this number." And that number he's saying might be $100,000 less or $50,000 less than what I was sort of happy to pay. I'm like, okay, well, if you think that's about right, and we would do it, and then we've got some really great deals like that, or just having someone else negotiate on your behalf. I think it's a huge advantage in this. So that's definitely one tip, I think, for people who are moving in to negotiate, especially in the Manhattan marketplace, but probably in others as well, not to get emotionally attached to deals, because you end up paying more and getting a worse deal when that happens.
And sometimes when you offer the asking price, you may not even get it, because sometimes when the asking price is such, you offer that asking price, the seller is going to think, oh, maybe I didn't ask enough. So I changed my mind. Now I want a higher price.
Yeah,
Right?
exactly.
So sometimes the negotiation is to make sure you get the deal by offering less,
Yeah.
and then the seller will counter a bit, and you want the seller to feel that they have gotten everything he can out of you.
Yeah, yeah. I've shared on a previous episode how one time we were buying a property in Manhattan, and we were at a point, and I think this one was in Tribeca, we were at a point where we were getting close to the price, but we weren't really agreeing on the price in the negotiation. And then you said to the seller, well, okay, you can include the furniture and the fridge, and the fridge was a Sub-Zero fridge, which I think is like a $20,000 fridge or something. So when you've got an open mind and towards negotiation, I think it can really help with those types of situations as well, to find that win-win that we often talk about.
Yeah. And being nice to the other party is so important, because people want to do deals with people they like. And this is something that you don't really think about. Usually people think negotiation is playing hardball, showing how tough you are. But when you do that, they are going to try to play hardball as well, right? To protect their own ego.
Yeah, absolutely. There's so much psychology behind all of that. I've just finished up doing a virtual course all around negotiation, actually, with Harvard. And we speak a lot about that psychology, and people who think negotiation is just about back and forth, power plays, miss out on a huge chunk of the positive side of negotiation, which is really finding, how can you make this a win-win, and you don't need to be an asshole to be able to do that. Going back to the investing in Manhattan, if you wanted to invest in a property in Manhattan tomorrow, or you were recommending someone and they hadn't done that before, what type of property would you be looking for? And let's say that at the lower end of the price spectrum, what sort of things would you look for in a property?
Well, at a high level, it's a condo versus a co-op, because these are the apartments where you can buy. You want a condo because a condo allows you to rent out whenever you want, and a condo doesn't require board approval. So as an investor, you have to buy a condo. Okay, so after you have decided on buying a condo, which is only 10% of the inventory, then there are three things to look at. One is the location. Number two is the building. The building has to be a high demand building. So just because it's in a certain location doesn't mean that all the buildings are good in that location. It's also building by building. So it has to be a high demand building, meaning you look at the number of sale listings, number of rental listings, how much they're asking for rent and for sale. You'll be able to tell if it's a high demand building. Okay, and then you have decided on the building. The third thing is that you need to select the apartment line. Now, Manhattan is a situation where you have one building next to another, no gap. Okay, so for each building, there's a preferred exposure. For example, facing north, you may be looking at a park, but there's not going to be a view on the east and on the west because it's next to other buildings. But facing south, you are staring at the back of the building behind you. Right, so for every building, there's a preferred exposure, and you want to get the preferred exposure of the building. You may be in a great building, high demand and all that, but if you are staring at another apartment, then it's not that great, right? Because when you're renting out, the tenants are going to say, oh, I'm going to be looking at this apartment the whole time, right? And when they're selling, the buyer is going to think the same also.
So you spoke a little bit about, I remember one of the things that you also mentioned to me relating to location is things like being close to the subway lines, maybe if it's a residential area like Tribeca and West Village, having restaurants and so forth nearby, maybe having supermarkets nearby.
Yeah, being close to subways is important because 90% of people in Manhattan do not own a car. So we travel by subway or by cabs and Ubers. When people go to work, it's usually by subway. The reason is that it's a lot more predictable. If you call an Uber or a cab, there's going to be traffic. It's a lot less predictable. So after, people who just moved to Manhattan, they may be using an Uber or cab initially, but after a while, they're going to realize that it's a lot more efficient by subway. So close to the subway is important. Close to the grocery store is important. For example, close to Whole Foods is important, because otherwise you would have to carry your grocery and walk for, let's say, 15-20 minutes, versus if you're close to a Whole Foods, then it may be across the street or across 5 streets. Makes it a lot more convenient. And of course, having restaurants is what makes an area desirable, because it's one of the things why people love Manhattan, right? It's the diversity, and that diversity includes the diversity of food and cuisines, because ultimately that's entertainment.
Yeah. And so we've spoken a little bit about the different neighborhoods and things that people might want to look for. In terms of the numbers in a Manhattan condo, buying a Manhattan condo for the first time, what kind of a return on investment would someone be able to sort of hope for or strive to achieve? Or perhaps we could talk about the rate of appreciation, because I know that's also important. What are your thoughts around that?
Yeah, there are two components to the returns. There is the rental return, and that is what allows you to compare the rental return versus the other parts of the world, and let's say stock dividends or putting money in the bank. If you buy all cash in Manhattan, your rental return is anywhere going to be between 2 to 2.5%. Okay, so you pay all cash, you pay the common charges and property taxes, those are the operating expenses, then you're left with 2 to 2.5%, which is low. The reason it's low is that it's a very expensive city. Manhattan and London are the only two Alpha plus cities in the world, which means that they are the most international and so forth. So the rental return is low, and then the appreciation from 1999 until now, it averages about 6.5% per year. The prices go up steadily. When there's a recession, it goes down for about 2 years. And then it goes up steadily. When there's a recession, it goes down for about 2 years.
When you say it goes down, though, just to jump in there for a second, one of the things that I was looking at specifically before we started investing in Manhattan, was I had a look to see what happened in the 2008 financial crisis, because we were thinking, well, we could invest anywhere in the world. It doesn't have to be Manhattan. So I remember doing some analysis on property in Chicago. We did San Francisco. I think we looked at Austin and a couple of others as well. And all of these other cities in the United States in 2008, 2009, the value of property dropped significantly. Whereas in Manhattan, I feel like, and correct me if I'm wrong, I feel like maybe it dropped a little bit, but it's kind of like flatlined, sort of plateaued for a little bit, a year or two, and then it went up again. It wasn't like it went off a cliff and just plummeted the value of the property. Is that right?
Yeah, that's absolutely right. During the subprime and Lehman crisis, which was in 2008, 2009, it hit Manhattan 1 year later, so prices only came down starting in 2009, when rest of the US started going down in 2008. And rest of the US went down by about 35% on average. Manhattan was down by 15%. And Manhattan was down 2009, 2010. And then it started going back up in 2011. And similarly, during COVID, prices were down by about 9%. And then it recovered in the first quarter of 2021, and it started going back up again. So unless there's a recession, prices usually goes up steadily. And why does it go down a lot less? I think it's because supply is limited. Yeah.
So supply and demand. I think one of the things that has always appealed to me about the Manhattan marketplace is that I would struggle to think of a safer place in the long term to have money tied up in property, because, like you say, it's an Alpha plus city, which is essentially a ranking for different cities around the world. There's always high demand there. In the business sense, it's the number one city in the United States and the world. So I think from a long period of time, could you lose money, 10% in your value of property, 15%? if you're buying 1 year and you just get unlucky and there's like a pandemic or a global financial crisis potentially, but if you hold that property for 3 or 4 years and hopefully a lot longer, I think there's almost zero chance that the value is going to go down. And I'm almost I haven't actually looked this up, but I would bet a lot of money on it that if you looked at 10-year periods over throughout the history of Manhattan, there's probably never been a 10-year period where the property prices or values have dropped from where they were 10 years prior. It's been a continual climb. So I certainly feel like it's one of the safer ways to tie up money. Regarding rental contracts now, how do people, how do they work? I mean, how long is a typical rental contract? And the other question I had for you was around Airbnb. I know that in some cities this is legal and common. I'm not sure if it is in New York or not.
Yeah, rental contracts are usually for 1 year, and sometimes it's 2 years. Usually a tenant would want to stay for several years because there's a lot of upfront expenses for the tenant for each move. There's the broker fee, which is usually 15% of annual rent. That works out to be about 2 months' rent, which is very hefty. Then there's the board package fee, which is usually about $2,000. And of course, there's all the movers and all that. Moving entails big expenses. So rental contracts are usually 1 year. Anything less than 1 year would be what we would term a short-term rental. And right now, the short-term market, which are the furnished apartments where you have someone transferring from, let's say, London to New York to stay for 3 months, for example, that really dried up. So furnished rentals, short-terms are usually furnished. You can ask higher rents, but there are very few buildings that will allow short-term rentals. Most buildings would require minimum 1 year. The reason is that buildings don't want to have a transient resident population who's always moving in and out. That is with regards to rental contracts. And what was the second question?
I just asked about Airbnb. It sounds like it might be on a building per building basis, or do you know about Airbnb in New York? Just curious.
Yeah, Airbnb in New York City, they are not allowed on two levels. Number one is that they don't pay hotel taxes. So New York City doesn't allow them. And there was a situation whereby a landlord was caught and was fined huge amounts. And number two is that the condo boards or the co-op boards don't allow that because they don't want the building to turn into a hotel and have all these people coming in and out. So Airbnb, VRBO, they're not allowed in New York City.
You know, interestingly, on two of our sort of longer stints in Manhattan, we actually rented one of the times through Airbnb, and another time it may have been VRBO or another one. And I wasn't aware prior whether or not it was legal to do or not, but once we had actually rented it, I started questioning it because the person that was renting the apartment to us started saying, hey, you know, I'll meet you down on the corner, and you know, if anyone asks, we're old friends and you're just staying here. And it was all very shady, and it sort of that was when I realized that, you know, maybe Airbnb is not allowed in Manhattan. So obviously because of that, the next question I was going to ask is whether or not you know, subletting and things like that with Airbnb was a good option for investors, but I think we can just skip over that because it sounds like it's definitely not a good way to go. In terms of the outgoings, when someone owns a property, they buy a property in Manhattan, what are the different outgoings that they're going to have, the different expenses that they're going to have on either a monthly or a yearly basis?
Yeah, the main ones are the common charges, also known as the homeowners association deals in fees in the other parts of the country. Here it's known as common charges and property taxes. Those are the two big ones. So let's say you buy a property for $1 million and then your rents would be 5%, let's say $50,000 a year. So your gross rents are about 5%, but when you subtract the common charges and property taxes, that would be another, let's say 2.5% of the price per year, and that is how you end up with anywhere from 2 to 2.5% in terms of your net rent. There's also the insurance expense, but the insurance expense is very low. It's something like $1,000 a year.
And just a moment ago, you mentioned people tend to look for longer rental contracts because of the costs associated with shifting. Who would normally cover those costs? Is it the person that is renting, or is it the owner?
It's usually the renter who is covering these costs. It depends on the market, and right now the rental market has been the strongest ever, even relative to pre-pandemic. And when the market was really weak in 2020, for example, the landlord will pay the broker fee. But right now it has reverted back to the norm, which is the tenant paying the broker fee, the board package fee, and the moving fee is a tenant expense. So what the owner needs to pay would be the painting fee. Usually after there's a turnover, the owner would have to pay to have it repainted and endure the vacancy period.
Yeah.
Those are the owner expenses.
Okay, that's good. I feel like we're filling in some of the gaps here, and this is all certainly stuff that I needed to find out and had no idea about before I got started in Manhattan. One of the other things that I realized was that I think every area in the United States, for me, it seems like it's almost like a completely different country. It's like there's a completely different demographics, completely different markets. Everything is different. Whereas prior to investing in New York, most of the investing that we'd done was in New Zealand, which is obviously tiny compared to the United States and Manhattan, or Argentina, which is a whole other story, another rabbit hole to go down at some stage. If someone is looking or interested in investing in Manhattan, let's say they've saved up $100,000 and they want to get started in real estate, is that going to be enough money for them to be able to get into the New York City sort of market, get on the ladder there?
For Manhattan, the studio apartments, generally a good one, generally will start at around $650,000. And the down payment requirement, depending on whether the person is a foreigner or not, the down payment requirement for a foreigner is 40%, and so 40% of 650,000 plus the closing costs. For a local, the down payment requirement is a lot lower, usually about 25%. It can be as low as 20% if you are living in there. But usually when you're asking from an investment perspective, the banks would require higher down payments. So I think 25 to 30% down payment would be reasonable for investment purposes. So the barrier to entry is higher relative to the rest of the US, but we have to compare it on a global perspective, because Manhattan is actually cheap compared to the other top global cities, compared to London, Paris, Hong Kong, Singapore,
Tokyo,
Monaco,
probably.
Tokyo, right? So Manhattan is actually cheap, despite being one of the top two cities in the world. The other top city in terms of the Alpha plus being London.
Yeah. Which is the best website for checking out local property? If someone's listening to this podcast or watching the video, what is a website that they can use to find out about all the properties that are on the market and get an idea about values?
The best website is streeteasy.com.
Streeteasy.com. Okay, we'll provide a link to that in the show notes. And we'll also make sure we have links to your websites and profiles there as well, Weimin. Just before we wrap up, I want to talk a little bit about potential mistakes that people could make, or problems that people should watch out for and make sure that they sort of avoid when going down a real estate investment path. Is there anything that comes to mind regarding this? Maybe problems that you've seen or experienced or your clients have been through?
I think one very common one is to try to look for a property from the computer when you're 3,000 or 6,000 miles away, because the inventory is public information. You can go to streeteasy.com or you can go to any of the other websites. But the photos and the information there, they are all posted by the seller's agent. which means it's one-sided, right? The seller's agent is never going to tell you these are the downsides of the property. They are only going to say this is why it's the best property and therefore you should buy it, right? So real estate is so local. You have to be here to look at the property, or if the foreign buyer or the out-of-town buyer cannot be here, then have someone who will be able to act as the buyer's broker and to objectively let the buyer know these are the downsides, these are the upsides. So having a local perspective is extremely important.
Is there always a broker for each party? Is there always a broker for the vendor and always a broker for the buyer? Or are these things optional, or how does that work?
The buyer's broker is optional. When a property is listed, the seller would retain a seller's broker. And here in the US, the buyers usually would have a buyer's broker because the commission will be coming out of the seller side. So if the buyer comes without a broker, the seller's broker keeps the entire commission. But here in the US, most of the time, the buyer will come with a buyer's broker because they know that it's already part of the price. Then when there's a buyer's broker, then the commission gets split between the seller's broker and the buyer's broker. So if the buyer goes without a broker, obviously the seller's broker is going to prefer that, and the buyer is not going to get objective information because everything is going to be coming from the seller's side or the seller's agent side.
Yeah, I've always sort of thought of having a broker as I'm buying it just fills so many of the gaps for me. And even now that I feel like I know quite a bit about the Manhattan marketplace, when I was starting out, I definitely didn't. In fact, reflecting on some of the most common challenges, not most common, but some of the challenges that I had was, one, just coming to grips with the different terminology. Because this was different to me. I hadn't invested in the United States, let alone Manhattan before, and this is not just on the local terminology, but also the names of the loan structures and so on and so forth. Knowing who to go to for lending as an international person, not in the United States, how could I get lending? In fact, I had some of my best friends and people I knew told me, you're dreaming. You're not going to be able to get lending there. Knowing who to go to, for legal advice, knowing who to go to for ongoing management, knowing how to choose a solid property in the first place, and not being able to go into these properties myself. These were all challenges, and I think I really hit a home run when I was able to find you, because I was able to fill in all of those blanks and sort of get started in a way that otherwise I think would have been incredibly challenging for anyone who's not a local in the Manhattan marketplace to get started. So I think having someone on the ground in Manhattan who knows the market, who can act on your behalf in your best interest, it's kind of this concept of building an A team around you. You need to have a good legal team, you need to have good accounting advice, you need to have good experts who know the marketplace, and I think that's what you can do when you have a good broker like Weimin. Any other mistakes that you've seen that come to mind that you think people should be wary of or try to avoid? And it doesn't have to be related to Manhattan. It could be investing in property anywhere, really.
Well, during the beginning of the show, you were talking about looking at things from a numbers perspective. Your programmer and had done the numbers for you, and I totally remember that. And
It was probably like the most unusual thing anyone had done in a while. So what's this guy up to?
Yeah, I thought that, wow, this guy is so prepared and it's amazing. I wasn't expecting that at all. And some of the numbers, I was surprised also that, so here, let's say the average yield is 2.5%. Some of the examples you showed had like 4% or 5%, but then when I look at the location, it's too far away, or sometimes it's a co-op. And it's great where, let's say, you may have a walk-up co-op that theoretically could give you 5% when the market average is 2.5%, but how long is it going to take you to rent it out? Because it's so far away and it's a walk-up co-op and no one wants to be renting in a walk-up co-op and so forth. So these are the things that numbers won't be able to tell you.
Yeah. I think the other thing, I mentioned this earlier as well, was just the emotional attachment. I think it's easy to sort of fall in love with a property, even if you don't see it in person, or if you do see it in person as well. But you can fall in love with a property, and you get your heart set on it that you want that one, and then you can even go down this slippery slope of it's almost like a competition. And if other people are bidding on it, and you want to bid on it, and you want to win it, and you don't want to lose that, so that emotional attachment can be risky, because it can lead you to paying too much for a property, or buying the wrong property. And then the other one that came to mind while you were talking there was about being over leveraged, in terms of, I think leveraging other people's money is great, but I think you can take it to the extreme sometimes, and if you can't service a mortgage that you've got, then that's not a good place to be in. So we've always taken a conservative approach, and I think that's always worked out quite well. The last question I've got for you here is, I know you've got 2 kids. Are they like 11 and 13? How old are your kids now?
Yeah, 13 and 16.
13 and 16, okay. So
Yeah.
do you talk to your kids about investing, or are they interested in like what you're doing and stuff? Because as having young kids myself, and my kids are very young, 5 and 3, so maybe a bit too young to understand all of this, but do you talk to your kids about investing and share your knowledge with them?
Oh, that's such an important question, and I think that as a father, it's on me to make sure that they grow up remembering this. Yes, I try to teach them about how to look at properties, but what I try to do, which I think is going to be more powerful, is that whenever I have a vacancy, I have a tenant moving out, I would have my kids go and help me clean the apartment. Right? Because this is something that you're going to remember, that I've always had to go and clean and prep these apartments whenever there's a tenant moving out. Why is that important? Because that is more memorable than them doing numbers, right? It puts things into context, it makes them work, and they are going to remember that this is what being a landlord is like. And hopefully they are going to be a landlord as well when they grow up.
I think the other thing that it does is it exposes them to different types of properties that are out there. I mean, when I grew up in New Zealand, I was growing up in a very small town, 20,000 people was the size of the town, and I lived 20 minutes away from there. So, I never had the opportunity to go into any of these kind of, large, tall skyscraper apartment buildings, or even just properties with that kind of a value anywhere around where I was. So I think being exposed to that is amazing at that kind of an age, and it could be exposed to any kind of a property. I'm not saying it has to be high-end Manhattan condos, but just understanding that someone owns this, and someone else lives in it, and they pay money to be able to live in it, and that's called rent. And if you're the owner, then you could keep that money. So I think that's something quite valuable. What about in terms of reading? Are there any favourite books or things that got you excited about real estate when you sort of started to get into real estate?
This was back in about 2005, and I started reading the Robert Kiyosaki Rich Dad Poor Dad series, and I read all of the books, and that was what got me to go to North Carolina to invest. I think that series of books really explains real estate and why it's important in terms of wealth building. But do be careful in that, for example, a $25 positive cash flow, just because there's a $25 positive cash flow may not mean that it's a good deal. Because for every month of vacancy, you are wiping out, let's say, 1 or 2 years of cash flow. So it's important to understand that books are written because they want to sell books, and real life experience as well. So I think a combination of the book knowledge and also getting experience from people who have done it before. The combination is important.
Interestingly enough, I read all of the Robert Kiyosaki books as well. They were one of the first real estate books that I can remember reading, and it would have been in around about 2001, 2002. And I think the big idea that it left me with was, okay, this is actually doable, and there's a way that I can build passive income here, and I can build that pipeline of cash flow. So instead of to use an analogy, instead of walking up the hill with 2 buckets to bring back water, I'm going to spend my time building a pipe that connects up to the water source and delivers the water right to my home. So the analogy of putting in some effort and time and energy to build a pipeline for passive income, rather than needing to bring those buckets down one at a time full of water, which is hard work and not scalable. So I think there is some really good content there, and those books now, I probably look at them, at the time I was reading them, they were as important for me from a motivational standpoint as anything else, because they painted this picture of what real estate investing could be like, which I wasn't really savvy to at the time. And I think anyone can head over to Amazon though and do a search for property investment, and there are hundreds, thousands of books on the topic, and I'll be sure to include links to a few of my favorites in the show notes. So with that said, thank you so much for taking some time out of your day here, Weimin. Always a pleasure to catch up with you, and looking forward to hopefully seeing you in the next few months again.
Thank you very much, Aidan.
All right, guys,
I appreciate being here.
Fantastic. This is the wrapping up of episode number 22 of The Growth Booth, where we've been talking about property investing and diving into the Manhattan marketplace. In the next episode number 23, we're going to be talking about investing in the stock market and talking about some of the pros and cons to doing that, and that will wrap up this trilogy that we're doing here on wealth building. So thanks for tuning in. Remember to head over to thegrowthbooth.com and episode number 22 to get show notes and a transcript, links to all the important places, and so much more. I'll see you on the next episode.